Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about a great tax planning strategy called the investment management fee waiver strategy. If you haven't watched my other video on whether or not you can claim tax deductions for investment fees, I highly encourage you to watch that video first because that will help you understand the problem that we're trying to solve. So under current law, we have this issue as investors in investment funds, whether it's private equity, venture capital funds, hedge funds, real estate funds, any type of fund that you're invested in, you are not able to claim a tax deduction for management fees paid to the general partner that manages that fund. So most investment funds have that 220 structure where you pay an annual 2% management fee, and you also pay a 20% carried interest component. So that is just really 20% of any upside appreciation in the assets that the fund owns when it disposes of those assets. The investment manager also gets that carried interest component. But what we're covering here is that 2% management fee that we pay every year to the fund manager that manages the investments in the assets that the fund owns. So we actually have two issues here. So we as investors have an issue of we can't claim a tax deduction for those expenses. And if you know me, you know I absolutely hate non-deductible expenses. On the other side of the coin, the fund managers themselves have a bad tax result because the management fee income that they receive, while they're happy to receive that money, that is taxed to them as ordinary income. So that is actually the worst type of income you can receive other than salary income. And they don't like it because they have to pay a high tax rate on that income. So the solution here actually solves the problem for both us, the investors, and the fund managers themselves. And that's one of the big reasons I like this strategy is that it's a win-win for everybody. And when everybody wins and everyone's interests are aligned here, I think that's a great tax planning strategy that can accomplish a lot of different goals here. So the solution that was actually developed is that instead of receiving that management fee currently, the general partner waives their right to those management fees. So if you read your subscription documents for a fund you're investing in, or if you see language around the general partner is going to or may waive their management fees, then that's generally what they're trying to accomplish here is this management fee waiver strategy. So what the fund manager does is they waive their right to management fees. And instead of that, in consideration for that waiver, they are going to receive a rights to future profits of the fund. So they're going to receive a profits interest or additional profits interest in the fund that entitles them to an additional, upside appreciation in the future performance of the fund, kind of similar to the carried interest component, instead of receiving those management fees that are paid to them every year. So the reason this is a win-win is that we as investors are going to get an effective tax deduction for this. So we shift capital gain that would be taxable capital gains from ourselves to the general partner. So instead of paying out this management fee that we don't get a tax deduction for and just claiming that as a deduction under other income from the fund, which we would have done under prior law, now we don't get a tax deduction. So instead of paying that management fee out every year, we're going to reduce the capital gains that we receive when the fund starts disposing of assets or just otherwise that we would have received for performance of the fund. So because we're reducing taxable income to ourselves, we are effectively creating a tax deduction. So that is how the waiver actually generates a tax deduction for us, is that when we couldn't deduct an expense we paid, we are just on the other side reducing taxable income that we receive. So we, the investors, are happy because we get our tax deduction and we effectively get a tax deduction for the fees we have to pay to the general partner to manage the fund. The general partner is also happy because they converted what would have been ordinary income management fees into long-term capital gain taxed at lower rates. So that's why they're also happy, and that's why this is a win-win for everybody. So just so you can kind of see how bad this result would be in practice if the fund manager doesn't actually do the waiver strategy, let's assume that you're an investor in a fund that you invest $100,000 in. So common fact pattern where I invest $100,000 in a fund and that fund requires me to pay a 2% management fee every year. So let's just say, to make this basic, that the assets under management for the fund are only $10 million. It's a very small fund. then in that case, the annual management fee is going to be $200,000. So the fund, every investor in the fund collectively is paying $200,000 to the fund manager to manage those assets and those investments. And that's 2% of 10 million. So you can see that's a very large number. And your share of that as an investor, if you invested 100K, then your share is $2,000. So you are paying $2,000 every year to that investment manager to manage, that fund and as your right to invest in the fund itself, and you do not get a tax deduction. So again, that is paid every year and it's non-deductible. So that's very bad. That's a hard cost where you get to no recoup on the tax side for that. So we can see why that would be a very bad result. So instead, let's say we work with a really good manager and they do this management fee waiver strategy. Then what they're going to do, instead of receiving that $200,000 management fee from the fund investors every year, they're going to convert that into additional profits interest. So they're going, and there's all kinds of math and different calculations that would be done to make that add up. But they're going to effectively have an additional profits interest in the fund, and as opposed to receiving that $200,000 every year. So one thing I want to mention, and this isn't really relevant to us as investors, but it sounds very easy, this waiver of the management fee, but there is a lot of complication on the side of setting this up properly. For the fund manager's perspective, they do have to work with really sophisticated tax advisors that understand how to do this right, because there's all kinds of rules where it could be disguised or recharacterized back as ordinary income if they don't do it right. So they do need to work with very sophisticated lawyers and tax attorneys in setting this up. It's not as easy as it sounds. There's a lot that goes on behind the scenes that you don't see. The other thing I'll mention is that I really like when fund managers do this. Every fund I invest with does not do this, but I actually think it shows that, one, they care about me. I mean, I know they themselves get a benefit out of this by reducing the tax rate they pay on the money that they receive, but they care about me as an investor and they don't want me to have to pay them a fee that I can't claim a tax deduction for. So I really like that they're willing to, implement this strategy and create a benefit for their investors. And I also think it shows that they really stand behind their strategy and believe in themselves and their track record. So instead of getting that money currently, which yes, they do pay, if they were to get the management fees, they may pay a higher rate of tax on it, but they're getting that currently and they're paid that regardless of whether or not the fund performs well. So the fund may actually be performing really poorly, but the fund manager is still getting their management fee regardless of that performance. And that takes some risk off the table for the general partner. So they would generally like the management fees and reduce their risk, as opposed to only being compensated on the upside performance of the fund in the future. That you can see creates more risk for the general partner, because if the fund doesn't perform well, they don't really get paid anything because they're not getting their management fees. So I like when the fund manager is willing to do this, because they're sticking their neck on the line. They're saying, we don't get paid if you don't get paid. And I really like when interests are 100% aligned. So when I see a fund manager that does implement this strategy, it's a good check mark for me, as far as I really think they believe in what they're doing in themselves. But that's not to say I only invest with managers who do this. I have a lot of investments with general partners, fund sponsors that do not do this strategy for various reasons. So I'm not going to tell you that, only the best do this. There are a lot of really quality sponsors out there that don't do this strategy, but I want to make sure you understand it. It's at least worth a conversation with your fund manager before you invest, if they've considered this, why they do or don't do this strategy. And also, if you invest in real estate funds, there are some other, strategies that can accomplish the same result, where a lot of times you might see real estate funds, instead of doing a management fee, they'll do a property management fee. So the fund manager gets a fee that is in exchange for managing those properties. Property management fees are tax deductible. So if it's a property management fee, that is tax deductible. Also, you might see them restructure these as acquisition fees or other types of fees, where they can make them tax deductible and they're not just pure management fees paid to someone who's managing the money or, managing the investments that the fund holds. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.